following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we're going to be talking about money, the answer about money, the name of the program, and we're talking about the markets. Got a great guest today. You want to hear what he has to say? I think it's a company of the future. You're going to hear about it more and more as time goes on. And, you know, with what's going on in the market today, secular bull markets don't die of old age. But we're now 9 years into this. And you have a lot of people that are raising a lot of questions. 9 years seems like a long time. And the economists made an analogy because we've been seeing things go on. We've been seeing the Bond Vigilantes, as they're so called. We see the Bond Vigilantes out in mass right now. We're going to talk about the Bond Vigilantes later in the program and what they're saying. But the economists made an analogy in saying that the market is like watching a horror movie, where you have a character that walks in darkness or walks out into the darkness alone. You have creaking floorboards and sometimes an eerie sound. But you know, sometimes that eerie sound is nothing but the wind. You know, I think we're going through this whole process, and I think what we're hearing is the wind. But we're going to come and talk to that later in the program. So you want to hear what I have to say there. But I just came back. Last week's program, or the week before program, was about Bitcoin and bubbles. Last week's was a repeat program. The reason was I was gone. I went to Nashville. There was a conference called the National Association of Pension Advisors. And it moves around the country. It was in New Orleans one year. It was in San Diego. It was in Las Vegas last year. It was in Nashville 2 years ago. And then 2 years ago, I flew in on Saturday night. It begins at Sunday at noon. So I saw a little bit of Nashville, but mostly the conference. This time I went a couple days earlier because one thing that has been bothering me for a couple years is, why did Nashville become the center of country music? There's nothing to recommend Nashville as the center of country music when you think about it. It sits on the Cumberland River, which is not a main river. It's not like being on the Mississippi where things would have floated up and down. It's a kind of a tributary. And when you look around, there's not a great amount of activity going on. So why did Nashville suddenly become the center of country music? So I have to tell you this story because I spent some time. I enjoyed the visit. I enjoy history. You know that I enjoy history. I talk about history sometimes. So Nashville sits on the Cumberland River, and there was a riverboat captain that used to move things up and down the Cumberland River to the Mississippi, and maybe went up and down the Mississippi as well. But he had some riverboats. His name was John Ryman. Late 1800s, John Ryman built his home in Nashville, was a pretty successful business person. And during that time, as Nashville began to grow, he met an evangelist, and he became a born-again Christian. Not only did he become a born-again Christian, but he built a church, and he built a pretty large church, and it was called the Union Gospel Auditorium. Now, when he died in 1904, the Union Gospel Mission, or the Union Gospel Church, they decided to rename after him, so it became the Ryman Auditorium. You can visit the Ryman Auditorium. But the Ryman Auditorium was a church. But as things went along, attendance began to drop off. Financially, it began to struggle some. And there was a woman, the secretary, Lula Neff was her name. She began to book things in to increase the finances. She booked in politicians. She booked in symphonies. She booked in comedic acts. She booked in some music. She booked a lot of different things coming in, theater. she began to book it into the Ryman auditorium to supplement the income because the church wasn't enough. And more, she began to book more and more. She began to go to New York City to book acts into the Ryman auditorium. And she would continue to do that for 50 years. Well, in the 1920s, there was a life insurance company called the National Life Insurance Company, and their motto was, "We save millions." And they built a big radio station with a huge transmitter. "We save millions." The initials are WSM. That became the call letters for the radio station, WSM. And they began to do programming. And one of the programs was the Barn Dance. But the Barn Dance was owned by the Opry Entertainment Company. Now you begin to see where we're going with this whole thing. The Opry Entertainment Company would invite people to come and hear and come to dance. And you had an audience. But they soon outgrew the radio station facility, and they had to move to another facility and then another facility. And eventually, they moved to the Ryman Auditorium. And from a 4-hour program, it became a 2-hour program. Now, if you've ever been to the Grand Ole Opry, it's an experience to go to. But the Grand Ole Opry is a 2-hour radio program. 7 days a week, 52 weeks a year. It's a 2-hour radio program. And the way it's been structured since the 1930s or the 1940s, late 30s, early 40s, is that each half hour you have a host of that half hour and you have 2 entertainers. So the host actually does some entertaining. You might have somebody like, I saw Vince Gill do host 1 half-hour segment. And so you have a significant host who will actually do 1 or 2 songs or whatever, and you have 2 other entertainers that are there. So in total, every single day, you have 12 entertainers on that program. Now think about it. 12 entertainers, 7 days a week, 52 weeks a year. That's over 400 performances that have to be done. So the natural upshot of that is you began to get a migration of people that wanted to perform on the Grand Ole Opry. That was and became the center of country music. So even there, when you talk about Nashville and talk about the Grand Ole Opry, that's the reason why it's called the Country Church of Country Music, because originally it was a church. Now, in 1974, they outgrew the Ryman Auditorium. They moved into a big facility outside of town. The Ryman Auditorium today books a lot of things from the Decemberists to pop. Well, the Decemberists are pop music. They were playing when we were there. But they'll book a number of different acts into the Ryman Auditorium. The Grand Ole Opry still continues to be the center for country music. Now, the reason I brought that up is I think there's some parallels. I was there for the National Association of Pension Advisors. And during that time, that was a time I went to hear what was going on, because the plan sponsors are often left with their 401ks. And the surveys show for 401ks, for retirement, for employees, their number one concern when they do a long list of what are your major concerns, retirement is a number one concern. That's for the over 40, and even now for under 40, that's become a major concern. That was what that retirement, the National Association of Pension Advisors, one of the things that I went to see how they address. And I go every year. I check out to see what goes on. I check to see things like why plans don't have enough participation, why account balances are too low, why people aren't saving enough, and why account balances aren't growing enough. Sometimes because plans have compliance problems. So I go to see how those issues are being addressed and by whom they're being addressed. You know, in that conference, there were 1,200 financial advisors, 1,200, and another 1,100 support people, vendors, everywhere from the fund companies to the record keepers to the advertisers, the whole thing around that conference. 2,300 people in total, but 1,200 financial advisors. And most of those financial advisors were working with very large plans, over $100 million, some billion-dollar plans. And many of the advisors were working on teams. I sat at a table once, talked to a guy. He had 116 financial advisors working for him, and he was coming up with a number of ideas to approach. Now, when I went to this, and as I go each time, there's 3 different classifications of financial advisors, or more appropriately, fiduciaries. There's what's called a 316, a 321, and a 338. And they all come from the Tax Act, which was the ERISA Act, the Employment Securities Act, that was passed in the 1970s. They defined different types of fiduciaries. The 316 fiduciary was a very easy one to satisfy. It's basically the record keeping. All you're doing is keeping the records. The only way you get in trouble is if you screw up the records. Not very difficult. A 321 is a little more difficult, and the 338 is the most difficult. We're coming to a commercial break, so I'll come back to this right after the commercial break and come back as to how all this applies to Nashville. I've got a great guest, and we want to finish with the Bond Vigilantes. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the conference in Nashville. National Association of Pension Advisors, 1,200 advisors, 1,300 support people, or 1,100 support people, 2,300 people in total. Large conference, a lot of breakouts, some keynote speakers. But most of the advisors there were working on, as parts of teams or heads of teams, working on big plans. And I started to talk about the different types of fiduciary because anybody that's working on a pension plan has to have a designation. A 316 fiduciary, or falls under the 316 rule, is one in which the person is simply keeping the records. 321 is a person who has no liability for the plan. If something goes wrong, they can't be sued. All they're there is giving some advice. 338 fiduciaries take full liability. If something is wrong with the plan, they can be personally sued. That passes through. I have a very big interest in that because if I get sued on a 338 fiduciary responsibility, it doesn't get stopped with a limited liability company like AFC. It comes through personally. They go after my house, they go after my cars, they go after my kids. I mean, actually not after my kids. I'm taking a little bit of an exaggeration, but it's a personal responsibility. And what I have always been surprised at is most of the advisors that are at that conference are actually 321 advisors, not 338 fiduciaries. Department of Labor addressed that problem or tried to address the problem. It's still in a state of flux because the Department of Labor felt being a 321 or falling under the 321 section of the IRS code was not really taking responsibility for the plans. And there's some problems with the plans. If you look at it, there's 515,000 plans. They cover about 55% of Americans, working Americans. The average balance is $96,000. The average balance for somebody retiring with 30 years of experience is less than $150,000. That means that these plans have been generating an income, or will generate when somebody retires with 30 years of experience. They'll generate an income of $300 to $400 a month. Hardly what you would call a replacement of their ongoing income. So there's those issues. And the Department of Labor came out during the previous administration trying to address that problem, making a fiduciary rule. Well, the courts overturned that rule a couple weeks ago, and now it's in a state of flux. But what I'm trying to say is that most of the advisors were 321, fell under Section 321 where they took no liability. Now I do a 338, so I take all of this very, very personally. You know, most of the advisors there were working with very big plans, so I was there to gain a lot of information. We work with plans that are under $10 million. That's our focus, and that's where I think it's an underserved market. But I was surprised to see the number of advisors and talking about selling success. Very few were talking about what they were doing for the plans. Most were talking about success. There was one breakout session because what we're seeing in the 401k market is that fees are being compressed. People are competing, and there's a great deal of compression. And one of the breakout sessions was talking about added revenue sources, how to increase revenue, talking about different things you can add on, health savings accounts. There is a credit card that will actually add to a person's balance. All these things that were going on to add revenues. And I'm for. I like to have revenues added to my bottom line. But I was surprised that there was a greater focus on fee compression than there was on performance. There's a greater amount of focus on fee compression than on what you're doing for plan participants and sponsors. I was surprised at that. Maybe I wasn't surprised. I expressed surprise, and really, it wasn't a surprise, just disappointing. So I had a lunch with a prospect who I would guess would fairly soon become a client. And he mentioned a neighbor who's a financial advisor and has been a financial advisor for a number of years. And the financial advisor made the comment that he's made a lot of money for clients. So my lunch guest understood something about this. If someone begins with $10 million and his account grows to $11 million, he's made $1 million, and that's a lot of money. But if you put it in the context that it took 10 years for that account to grow from $10 million to $11 million, it doesn't look so good. Yes, it's a lot of money, but over 10 years, that's not a very good return. That's 1% per year. Not a great deal. So, people express a lot of things. And I think it was Abraham Lincoln that asked the question, how many legs does a dog have if you call his tail a leg? How many legs does a dog have if you call his tail a leg? The answer is the dog has 4. Simply calling a tail a leg does not make it a leg. People are concerned. People want to say, and I'm going to another conference where it's really prevalent, where they talk about the amount of money people make, and they don't measure the returns. There's very, very few financial advisors that really post their returns and say, this is how I've done for clients. You can say anything you want to say. You can say I made a lot of money for people. You can say I've got a lot of great clients. I've got a great portfolio. But until you have a real basis of comparison, do you really know? It's the numbers that count, in my opinion, and only the numbers. Anyway, that wraps it up. I think when I talked about Nashville, seeing that, Nashville was a place that had nothing to say for itself in terms of being the center of country music. But it brought together that whole group. And because it was able to do that, it made something that's very special in Nashville. It's something that has become the country church of country music, the center of country music, because they focused on finding what they were good at, and it's become a very cultural thing. It was interesting to go to, I have to say. I'm not sure that I would like to live there, but that's another whole story. Anyway, that wraps this up. I want to talk about my guest today. I want to introduce my guest, Sean Iadinato of Canetta. Welcome to the program, Sean.
Thank you very much. Pleasure to be here.
So, Sean, tell us about your background.
So I have a PhD from the University of Washington in genetics, and I've been in the biotech industry for my entire career, focused mostly on drug development.
So I think this is really appropriate because I used to build portfolios around a theme. And the theme in the late 90s was that the 19th century, the 1800s, was the century of chemistry, steel and aluminum and oil. The 20th century, the 1900s, were the century of physics with flight, with the internal combustion engine, with electronics. The 21st century is the century of biology, and you're right in the center of that.
Yeah, it's an exciting time.
So you started a couple companies before.
I have, yeah. I've started a few companies in Seattle, are mostly focused on immunology, inflammation, pain. Our last company was a company we sold to Cubist, which is now part of Merck. And Kineta is a company which I'm very proud of. We've been in business for about 7 years, and we're focused primarily on cancer and pain and inflammation.
So let's talk about what you're doing in terms of pain and inflammation, cancer. Tell us about your drug development.
Yeah, so I think, most of our work is really focused on new drugs. We see in the industry only about 30 new drugs being approved every year. A lot of the drugs that people are taking are older generation drugs. So there's a real focus at our company on drugs with new drug mechanisms, things that haven't been used in patients before, and really taking the risks that are needed to bring those into clinical trials and to the market.
So you have a drug called KC406, right?
Right.
So first of all, how do you get to KC406?
So those are KC just refers to the company. It's a number that we use at Kineta, or a nomenclature that we use at Kineta. And 406 is just the 406th analog in the series, which happened to be one of the best.
Okay. So what does KC406 do?
So the drug is analgesic. It's like an opioid. It's designed to treat chronic pain, but it's different in the sense that we think it won't enter the brain. It won't have some of the problems that opioids have, like tolerance, addiction, and some of the side effects associated with lack of coordination, lack of attention, respiratory depression, things like that.
Before we get to that drug, you mentioned opioids. So let's talk about how do opioids work. I mean, opioids has become nationally one of the critical areas that people are focusing on.
Yeah. Well, opioids are a very old drug. They've been around for 2,000 years. They came from the poppy, so they're a natural product essentially, and they're very effective at relieving pain. They interact with what we call a drug target in the brain and spinal cord that actually helps to quiet the brain and spinal cord. So opioids are mediating their analgesic effects by quieting those opioid receptors in the brain and spinal cord.
We're going to come back to this and talk more about opioids. We're going to talk about KC406 and what's going on with this development. We're coming to a commercial break, so don't go away. We've got a lot more to cover. If you missed part of this program, you'll find it on our website within a week or so. And we will also have it on iTunes. Don't go away. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Sean Iaddonato of Kineta. We started talking about their drug in the clinics, but before we got to that, we're talking about opioids dealing with pain. So let's go back to the opioids. because they're an old drug, they're a natural drug. So what is the mechanism on how they work?
Yeah, so the opioids, they have a target throughout the body, a protein on cells, on nerve cells called the opioid receptor, and they bind to that and they activate that, and that's how they mediate all of their effects.
So we're getting into technical stuff. So tell us what a receptor is.
So a receptor is something on the surface of a cell. It's a way for things that are floating around in our body and our blood to interact with the cell and cause the cell to do different types of things. And we have all different kinds, especially in our brain. We have dopamine receptors, serotonin receptors, and a lot of the drugs that we take for neurological conditions interact with those receptors.
Okay. And opioids do too.
They do, yeah.
So what is the issue with opioids?
So there are a few different issues with opioids. They're really effective drugs. If you have serious injury, you need them for a short period of time. You've had a surgery. But they tend not to work very well for people who have long-term pain conditions like chronic lower back pain, diabetic neuropathy, things like that. I think the other problem with opioids is that they have a lot of depressive effects on the brain. They affect cognition, motor coordination, memory, and also respiration. And so as people take opioids over a long period of time, they develop tolerance. They have to take more and more, and that's how they can accidentally overdose. They take too much of the drug, and they stop breathing.
So when we talk about that, we're talking about something like chronic pain that continues not just for a few weeks or months, continues for years and years and years, so that with an opioid, they have to take more and more as time goes on.
Yeah, a lot of studies have shown actually that opioids in general really are very effective for the first 8 weeks or so, but for people who are taking them long term, they lose their efficacy. Some people develop tolerance, and they try to compensate for that by taking more of the drug over time, but that just increases their risk of overdosing.
And we're seeing now 60,000 deaths a year.
The overuse of prescription opioids is a huge problem. We do have 60,000 prescription opioid overdose deaths in the United States. It's a major public health issue in the country.
So now let's talk about KC406, because I think this is a very fascinating story. How does it address pain?
So we think that the drug addresses pain by actually blocking pain signaling at the site of injury. So for example, if you injure your arm or your leg or your finger, we think that the drug mediates its analgesic effect right at that site of injury, as opposed to quieting the brain and spinal cord, which is what opioids do.
So if I have a problem with my foot, I injure my foot, I drop something on my foot, it hurts, and it continues to hurt for a long time, and I take KC406, how does it know that it's my foot and not my hand?
Well, like opioids, it has its own drug target, and that's expressed throughout the nerves, the long nerves of our body. And it will interact with its target, and it will block pain signaling. The drug is intended to be administered in a way that it goes all throughout your body, but wherever you have pain and inflammation, the drug should reduce that pain and inflammation.
So what's the source of the drug?
So like many drugs, the source is a natural product. The original drug came from a cone snail, an animal venom from the cone snails. And those are actually really rich sources of molecules that can later be turned into drugs through optimization or improvement. And that's what we did in this case. We took the natural product from the cone snail and over many years optimized it to work in this particular setting.
So how did you know to take it from the cone snail?
So the original molecules or drugs, earlier drugs that we isolated, that we in-licensed at Kineta, came from the University of Utah, from a lab that is run by a few scientists that have worked their whole career on cone snail venoms. very methodically isolating them and dividing out their various components and learning about what they do. And through that process, they happened upon an earlier version of this drug, and we've been able to make it better over time and optimize it.
So when you talked about the opioids affecting the brain and the spinal column, why doesn't your drug affect the brain and the spinal column?
Well, probably for a couple of reasons. So we talked about first the opioid receptor being in the brain. This drug has its own receptor, and we don't think that receptor is expressed very much in the brain, so it's not present in the brain. In addition to that, the brain is enclosed in what's called the blood-brain barrier, and actually only certain types of things can cross the blood-brain barrier, and only certain types of drugs can. And this drug has properties which prevent it from crossing the blood-brain barrier.
So the blood-brain barrier acts like a filter.
Yeah, like a sieve, and actually it's very unique in the body in the way that it can only sieve certain things that are in the blood can enter the brain.
So this actually becomes a real replacement for things like opioids.
Yeah, I think opioids will always have a place in an acute pain setting, like we talked about, a post-surgical pain setting. But for people who suffer from long-term pain conditions, we hope this can replace opioids.
So where you are in the development of this is a little ways away. It's not available on the shelf right now.
That's right.
So where are you in the clinical development?
So we'll be taking this drug into the clinic in about 18 months, and we'll evaluate it first in healthy volunteers to assess its safety before we go into patients.
And once you go into patients, you address safety and then dosage?
That's right. We address safety, we address efficacy, we try to find the best dose. Some of that work we can do in healthy volunteers, and some of it we'll do in patient populations, for example, people with chronic lower back pain.
And do you feel that you get an expedited review for this?
So I think given the environment and the fact that there are very few new pain drugs in development, the regulatory environment is favorable for a non-addictive treatment for pain.
And you have a very good partner in this, right?
Yeah, 2 weeks ago we announced an alliance with Genentech, which is part of the Roche Group. And Genentech is an excellent science-driven partner for developing drugs that are new and innovative.
And Genentech was the first biotech. It was one that was started with $100,000 funding by Bill Swanson, and that's a whole other story. Maybe one day I'll do a radio program on that because it's a fascinating story.
Really
but you
is.
have a very strong partner that's been around a long time.
Yeah, we're very fortunate.
Whose first product actually was human growth hormone.
That's right, yeah.
Which has come into big play in baseball, but that's another story too.
It is.
Well, that's a great story, and you're on the cusp of some really important things for humanity.
Well, thank you very much. It's an exciting time, I think, to be in drug development, and we've got a great team at Kineta doing really exciting things.
That's great. Thanks for being on the program.
Thank you for inviting me.
Look forward to hearing more and more information as you progress.
Thank you.
So I want to turn now back to the stock market and talk about things, because the stock market's been jittery. You know, both The Economist and the Barron's have had a couple articles talking about the Bond Vigilantes. Haven't heard the term for a long time. It's been maybe a decade since I've heard about the Bond Vigilantes. Those are the bond investors who look at interest rates, they look at bonds, and when you look at those people who are trading bonds, the so-called Bond Vigilantes, they're the people that will trade in and out of bonds. They look at bonds in terms of total yield. Now, if you look at a bond, it has three characteristics. It has an interest rate. That's the coupon, the interest rate, how much the bond is paying. It has, secondly, a maturity date. That's when it's going to mature and pay off. and it has a price. Bonds also have some characteristics like credit quality and how safe it is. But those are the three primary things: the interest rate or coupon, the maturity date, and the price. And the price will depend upon the market and what the market is doing, and also on credit quality, of course. But if you look at equivalent credit quality, the price is going to trade with the market. And the total return, if you're looking at bonds, the total return on a bond is 1/3 from the coupon, 1/3 from the changes of price, and 1/3 from the reinvestment of the coupon. So the coupons are going to throw off an amount of cash, and that cash gets reinvested, and 1/3 is how well you reinvest that. The Bond Vigilantes are really good at what they do. They look at that and their total returns. Now, if you look at most financial advisors' portfolios, when they're doing a bond, they're doing a bond ladder, which means they have some short-term and some long-term, and some every 3 years or every 5 years or every year, depending upon the bonds. And we're going to come back and talk about that after the commercial break. So don't go away. We've got a lot to cover. Be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Okay, so I've been talking about the Bond Vigilantes, and when I left things off, I started talking about the return. And most financial advisors build a ladder. So you have a bond that expires in 1 year, 2 years, another in 3 years, another in 4, another in 5, another in 6. What you're really talking about is 2/3 of the potential return. They get the coupon that the bonds are paying, and that gets reinvested every year into a longer-term bond. And that's 2/3 of the return. But they're leaving 1/3 of the return on the table. They never look at that. The Bond Vigilantes are focused on that 1/3 of the return. And I learned a lot. I sat in my first year when I was a rookie broker, I sat with two guys who were Bond Vigilantes. I learned a lot about this. They didn't call themselves Bond Vigilantes. They called themselves bond brokers. That's what they were. That's all they did were bonds. And they had specific things they did. I eventually ended up doing some bond portfolios and understanding what they did and how they did it. And when interest rates were coming down, I mean, when I started in the business, tax-free bonds, AAA tax-free bonds were selling at 8% yields. That yield would drop to 2%. And what that did, if you have a long bond with a low interest rate, and at the time there were some Tacoma City Lights, Seattle Lights, there were some bonds that had been issued in the 60s issued at 4% or 3%. And what you have when you have a very long bond and a very low interest rate and a high interest rate is it's like that game we used to play, Crack the Whip, with as kids, where you'd get together and the kids would hold hands and the kid at the beginning would pull everybody around. And if you were at the end of that whip, man, you got hammered. Well, it was like that with those low coupon bonds with rates coming down. There were returns of 20% a year sometimes even greater, because the bond yields were coming down, and that meant the prices were going up, and there was a significant capital gain out of those bonds. The Bond Vigilantes, they didn't call themselves vigilantes, I have to say. The bond brokers realized that, and they were managing bond portfolios that were achieving returns which were almost equivalent to the stock market returns. While normal financial advisors were building those pretty ladders, they were focusing on that 1/3 that people didn't get. Well, what happened is interest rates got lower and lower and lower. And soon we were seeing treasury rates of under 2%. We got down under 2% to 1 3/4. Well, that price appreciation didn't come in. and gaining some of the gain, the capital gain, became a different game. Once you got down to that, you begin to do things like kicker bonds, and there's a whole philosophy on what a kicker bond is and how to maximize returns out of a kicker bonds. Sitting next to bond traders, I got to know a lot about kicker bonds. I got to know about defease bonds. I got to know a lot about the bonds, and I do some of that stuff, and I haven't been doing much because of interest rates being low. But that's where the bond brokers were. So something happened last November which triggered the Bond Vigilantes. And they're called vigilantes because they get really concerned about what's going on in the economy. They get really concerned about interest rates because 1/3 of what they get, 1/3 of that yield, depends upon price. And when things change in the market, in the bond market, they begin to get concerned. And last November, things changed. Normally, you have a yield curve where the interest paid on shorter-term bonds is much lower than what's paid on long-term bonds. For example, in the long term, you probably have short-term bonds, 1 or 2 year bonds that are paying 1%, and 30-year bonds that are paying 5%. These are U.S. Treasury bonds. Municipal bonds, it's in relation to that, about 80% of that on long term. So you have a bond yield where there's 3.5% to 4% difference between short term and long term. That's the yield curve, and it goes up from that beginning few months maturity to the 30-year maturity. It increases during that period of time. What happened last November is that curve went flat, or almost flat. Short-term yields went to, and are currently now in a flat curve. Short-term rates are almost 2.5%. 30-year rates are 3%. That's a very small difference. And so the Bond Vigilantes are looking at that and saying, that's something that is the outlook for market participants, saying this about the economy, that the economy looks very good in the short term, so you have to pay more to get people to invest in bonds right now because they can make more in the stock market. But the outlook for long term, 10 or 30 years from now, doesn't look very good. If we had 2 3/4 or 2.5% on the short end, we should have 7% on the long end in a normal time. Since we have only 3%, for the Bond Vigilantes, they're saying that raises all sorts of questions. And it's coming about for 3 reasons, according to the Bond Vigilantes. Number 1 is monetary policy. The Fed has been tightening. They've raised interest rates, short-term Fed fund rates, 1.5% since December of 2015. So you have monetary policy that's figuring into it. You have fiscal policy that is the second factor. And fiscal policy means that we have this big tax cut that we've done. So you're pumping a lot of money into the economy on the short term, but the long term is questionable. And thirdly, now you have a trade dispute that could be happening between China and America. And so that could be putting pressure, making things long term a real question. Add to that, from the stock market side, they're hearing from some of the stock market prognosticators who are saying that the VIX, the rate of volatility has suddenly increased. We went through 10 months, every single one of those 10 months, from March of 2017 to January of 2018 was a positive month, and then February was the first time we had a negative month. The last time we had 10 straight months of gains was 1959. Now we've got February that's down. March was up. But there's a lot of concern because April may be down. So there's a lot of more volatility. And when you look on a daily basis, you've got the same thing. So for the economists, they said there is an analogy like watching a horror movie where a character walks out into the dark alone, where the floorboard creaks, where you have this sound coming on. But in my opinion, sometimes it's just the wind that you're hearing. There's a lot of explanations for what's going on. The yield curves can be flattened simply because central banks are raising interest rates because they're buoyed by growth. There's short-term growth, and there's still a significant demand for long-term bonds. They're being purchased worldwide. There's issues about safety in the rest of the world. There's issues about what's going on in Russia. There's worries about what's going on in a lot of parts of the world. And so you have a lot of buyers for U.S. Treasury bonds. That explains a lot. Volatility increases not just because of bad news. It increases sometimes because of good news, because earnings are better than expected. Wages are reminding me up. So all these things factor in. It can be a sign of good times. Samuelson, remember, Samuelson was the economist, said the stock market has correctly predicted 9 of the last 5 recessions. I think this is kind of the same kind of thing. Stock markets rise on a wall of worry. Yeah, John Templeton said it concerning markets. Secular bull markets are born on pessimism. They rise on skepticism, they mature on optimism, and they die on euphemism. We're still early in the secular bull market. Don't go away. Next week, I've got a lot more to talk about in terms of growth.
Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. Following program is sponsored by Adams Financial